right, hello everybody. We are back. This is our second week of class, our fourth class period, and thanks for coming back. This is an important class period. We're going to be doing some good stuff today. We'll probably take just about the whole time, but be sure to pay attention because what we're going to talk about today, amongst other things, is we're going to introduce those financial statements that we'll be preparing this semester. A couple things for you folks at home. Hope you're doing well. Remember, if you have any questions at all, please email me. Okay, please email me. You all have my email address. Secondly, are you checking your emails that I send to you? Okay, and making sure that your email box doesn't get too full where it can't receive any more emails. So make sure that thing gets cleaned out, but you need to check that somewhat regularly. Okay, let's go ahead. What I want to do is start off the class by going over the homework that I assigned. Okay, now I hope you guys did this. The homework was basically over transaction analysis, a number of different ways to test if you understand how to do transaction analysis, correct? Now this is kind of that first skill that you need to be able to develop. So I want you all to have kind of the responsibility and maturity to be able to assess, do I really understand what I'm doing here? Okay? Because if you're way off on this transaction analysis, then we need to get together or schedule some office hours or to go to tutoring or whatever. Okay? So, but we don't want to get you behind. We need to take care of things as they go along because they all build on themselves. All right? Let's go ahead and take a look at exercise 110. Exercise 110. Okay? On page 31 in your books, exercise 110. Zen began a new consulting firm on January the 5th. The accounting equation showed the following balances after each of the company's first 5 transactions. Analyze the accounting equation for each transaction and describe each of the 5 transactions with their amount. Okay? All right, we can do that. Well, the first one, it looks like what went up is cash went up by $20,000 and capital went up by $20,000, right? So obviously what happened there is the owner of the business started the company by investing $20,000 of his personal money into it. Correct? Okay. All right, transaction B, you can see that you have to kind of analyze the changes here. Cash went down by $2,000, office supplies went up by $3,000, and AP went up by $1,000. So it looks like what they did is he bought $3,000 worth of office supplies, paid $2,000 of cash, and then the rest of it put it on his tab or put it on account or put it on credit, okay, and established a liability for that. Make sense? Okay. Transaction C, cash went down by $8,000, office furniture went up by $8,000. Evidently, they bought $8,000 worth of office furniture using cash. Okay. Transaction D, AR or accounts receivable went up by $6,000. Revenues went up by $6,000. Okay. Here they provided services to a customer and they billed them. Okay. Provide services to a customer on account, we might say. And then lastly, transaction E, looks like cash went up by $1,000 and revenues went up by $1,000. We provided services and immediately got paid the $1,000 in cash. Correct? Now I'll go ahead, and, as I often will do, and put those answers up on the screen so that you can take another look at them if you missed one. Okay? Is there any questions on that? Any questions on exercise 110? Not too bad, was it? Yeah.
Is that it's not the same as revenue? It's just whatever the owner puts into the company?
That is correct. That's a very good point, Erica. You talking about transaction A?
Yeah.
Yes. Transaction A, when the owner invests $20,000 cash into the company, that increases capital, okay, not revenue. Now, you're correct in thinking that this situation here with the owner investing assets into the company and revenue, both of those things are situations that increase owner's equity, okay? But no, revenue, you can't make up revenue. You can't like put money into the company and say, hey, I'm doing real good. I've got a lot of revenue. No, that was your money. Okay, we caught that. So it's a good question. But no, that's not revenue. That would go into capital. Good. Good. Any other questions on 110? Okay, let's turn over to 1.9. Exercise 1.9 was the next one. Now, for you folks at home, I hope you guys are doing this homework. It takes these TV classes or online classes can be very, very good ways to learn, but you have to have the discipline to do this homework. Obviously, I can't come to your home and see if you've done it or not. So make sure you're doing it as well, just like if you were sitting in this classroom. Okay? Exercise 1.9. Provide an example of a transaction that creates the described effects for the separate cases A through G. And a few of these have more than one. Okay? So let's see how you did. All right. A, increases an asset and increases a liability. What did you guys get? Anybody?
Buy something on
Supplies
account.
on account.
Buy supplies on account. That's a good one. Very good. Buy, not buy a loan, obtain a loan, right? Go to the bank, you get a loan, your asset goes up of cash, and notes payable would go up, okay? So the first one that you said, though, buy supplies on account would be AP goes up, supplies goes up. You can buy a piece of equipment on credit as well, okay? Good, good. Transaction B, decreases a liability and increases a liability. This one's kind of a weird one.
Yeah.
What's up with that?
I didn't know.
Okay. Well, what that would be is, and this is actually somewhat relevant to these times, and I just did this situation about a month ago. Okay. Anybody here own a house? No? Anybody here who's got parents who owns a house? Yes?
Yeah.
Okay. I refinanced my house. Okay. So I had a fixed rate at 5.75%. Well, I could get a new loan at 4.75% interest. Now, which would you rather have? Which interest rate would you rather pay, 4.75 or 5.75? 4.75. So what I did is I refinanced my house. There was no money coming into me. What happened is this loan just went down and this one immediately went up. Do you see what I'm saying? So my new loan was to pay off my old lender. So the benefit to me is now I pay less interest. But do you see how one liability went down, my old mortgage, whereas a new liability went up, my new mortgage? So that would be an example. Well, that's kind of more of a personal example. Let me give you an example of more of a business sort of situation. Let's say that Peter, let's say that you owed me $1,000. Actually, are we talking payables or receivables? Okay. Let's say I owed you. We're talking from my perspective. Let's say I owed you $1,000 on account. Okay. So I have an account payable to you. Of course, you have an account receivable for me, right? But I have an account payable to Peter for $1,000 for some office equipment that I bought. Okay. Well, let's say times are tough. So what I do is I go to Peter and say, Peter, I understand I owe you $1,000. I've been your customer a long time. I'm just being honest with you. We're having some cash flow problems. What he might do is we might get rid of that account payable and set it up as a note payable. And what we might do is he might say, I tell you what, let's set you up on, let's have you pay $200 a month for the next 5 months or so. And I'll go ahead and charge interest of 6%. Does that make sense? But he would set me up on a payment plan, right? So my account payable went away, and I set up a note payable, okay? Now, Peter's probably good with that, too, as a business owner. Has anybody here ever done collections? It's a tough job. Okay, sometimes I have some students who do collections.
A loan shark?
Not like a loan shark. More like just somebody who for business calls delinquent accounts, okay? But as a business owner, if somebody owes you money and they can't pay, but they call you up and they let you know the situation, and maybe they establish a payment plan, and of course, if they follow that payment plan, you've got no beef with those customers. You're very happy with them, right? It's the customers who don't pay you and they don't answer the calls, they don't answer emails, and all that sort of stuff. So there are times in business where we will owe somebody an account payable or something, and we'll set it up as a note payable instead. Because that gives him a little bit more assurance as time goes on, doesn't it? Because I've signed something. Okay? Not as common a situation as some of the others we've discussed, but does that make sense? One liability goes away and a new liability is established. Lauren.
Isn't an account payable like where you have to pay it all at once, or?
That's a good question. Most of the times, not all the times. Not all the times. Accounts payable is just, are you asking for the differentiation between a note and an account payable?
Yeah,
Or-
because like it sounds like you're saying like a note you can pay over time as opposed
Well,
to an account
okay,
you
it's a
can't
lot
really-
more common for a note payable to be paid over time, okay, and according to a pre-established payment plan than an account payable. But there are times you'll have an account payable and you'll pay it off maybe in 2 or 3 payments, okay. So the differentiation isn't so much in regards to if there's a payment plan. It's more as if there's an interest rate involved and if there's stuff that's been signed. It's more formal, a note is. Okay, these are good questions. Okay. Okay, C, decreases an asset and decreases a liability. What do you think?
Taking the payment on a loan?
This is exactly it. We're making a payment on a loan or making a payment on an accounts payable. Correct? Using cash. Of course, like some other asset as well, perhaps, but you probably cash. Okay? Good. D, increases an asset and decreases an asset. Paid cash for supplies, paid cash for equipment. That would be a good one. Okay? Let's see if there's another one. There's another one in there. Purchasing something on with cash. Certainly. What if a customer, I think this would work, yeah. What if a customer owed us money? Let's say I had an accounts receivable from Zach for $200, and he paid me off with $200 cash. My cash would go up, my accounts receivable would go down, right? Those are both assets, correct? So that's another situation, okay? E, increases the liability and decreases equity, okay? I don't want you to worry about this one too much. Matter of fact, I kind of wish they'd skip it.
I thought someone pays for service, the service was not done.
Let's see.
Like the example that you gave.
No, that wouldn't be it, because that would be increases the liability, increases an asset, okay? Let me give you the answer to this, but then I want you to almost write a note in your book that says don't worry about E for now. And the reason is because E really delves into some Chapter 3 concepts, and we're not to Chapter 3, are we? Okay? So I'll tell you what the answer is, because I know it'll drive you crazy if you don't know the answer. But I don't want you to worry about it too much, okay? The answer to E is if you incur an expense that's not yet paid, okay? So you book an expense, but you haven't paid it off yet. But again, this is more of a Chapter 3 concept, okay? So don't sweat E. Let's go to F. Increases an asset and increases equity.
Business.
Let me think through that. Yes, owner puts money or equipment or any sort of asset into the business. Very good. Very good. That would be one example. There's another one too.
Someone pays for a service that is completed.
Yeah, I think you. Let me say it a little bit more specifically. This is us providing services or selling a product to a customer. Okay, and they could either be paying us in cash or they could be doing it on credit, because if we do it on credit, then our AR goes up, and that's an asset as well, right? So we could be performing services for a client. Capital or equity goes up, and either AR goes up or cash goes up. Either one's an asset, and either one of those situations would work. So there's a number of situations in this one that would suffice. What about G? Decreases an asset and decreases equity.
Owner takes cash out of business.
Owner withdraws cash.
For expenses.
Or you
Okay.
pay for incurs an expense and you pay it in cash. Very good. Very good. But this one gets you thinking a little bit more, doesn't it, this exercise? Okay? Now let me go ahead and put the answers up there if you want to take a look at those again. Okay? There's exercise 1-9 up on the screen. Let you take a look at those real quick. If you folks at home want to pause it, you're able to do that as well. All right. Any questions on that? Now what I want to do is jump over to exercise 12. Exercise 112 on page 32. And what we are going to do is we're actually going to start filling in some of these ourselves, aren't we? Okay? Kind of like we were looking at on the PowerPoint presentations last week. All right? So let's do that. Let's take a look to see here what they want us to do. Leora Diamond began a professional practice on June 1st and plans to prepare financial statements at the end of each month. During June, Diamond, the owner, completed these transactions. Okay, and they give us a number of transactions there. Create a table like the one in 1-9. Use the following headings for columns, da-da-da-da-da. Then use additions or subtractions to show the effects of the transactions on individual items. Now they say show new balances for each transaction. That got a little old after a while, didn't it? Probably. So if you didn't do that, that's fine. The main thing that they're trying to pound into your brains is that after each one of the transactions is analyzed, the accounting equation always remains in balance. Thus, assets equals liabilities plus owner's equity, correct? So let's take a look at that, but I don't care if you didn't refigure the balance, okay? Owner invested $70,000 cash in the company along with equipment that had a $20,000 market value, okay? All right, so these are, I'm going to get this straightened up here just a moment. Let me back it up a little bit. Lauren, how are you doing on the back row there? Can you see that, buddy?
Yeah.
If not, I don't know if that screen back there works for you. If you can see that one better. But okay, cash goes up by 70, equipment goes up by 20, and the capital for this lady goes up by 90,000. Right?
Equipment too.
Yes. Yes. Very good comment there, Lauren. Remember, the quiz was when the owner invests any assets, any personal assets into the business that increases capital. That might be cash, but it might, in this situation, also be equipment. So very good. Okay, B, the owner paid $2,000 cash for rent of office space for the month. Okay? Now, let's take a look at this. Now, I'm going to comment on this one a little bit. I really would rather think of this as an increase in expenses that is going to be eventually subtracted in arriving at what our capital is. We talked about this during the slides. Expenses in this situation is increasing. Expenses are increasing. However, as expenses increase, equity goes down. Does that make sense? So they put that minus sign there because they kind of skip a step, but I really wish they'd show that expenses are going up, but that eventually causes capital and equity to go down. Yeah, you could do that too. Just put parentheses between the signs. Is that right? Yeah, you could do that as well. But then, of course, your cash went down as well. Okay? Now, I don't want to hurry past that one if anybody has any questions or is confused about that. Anybody? Okay. They refigure the balances. Counting equation still holds. Transaction C. The company purchased $25,000 of additional equipment on credit. Equipment goes up and AP goes up by $25,000 each. Compute the new balances. Everything's good, right? Okay, transaction D. The company completed work for a client and immediately collected the $3,000 cash earned. Okay, cash goes up by 3,000, revenue goes up by 3,000. Everything is still in balance. Okay? All right. All right, next transaction. E. The company completed work for a client and they sent a bill for $9,500. Well, revenue goes up here by $9,500. And our asset of accounts receivable goes up, right? This is another reminder of that revenue recognition principle. We recognize revenue when it is earned. When is it earned? When we provided the product or the service. Doesn't matter when the cash is actually received. Here we haven't received any cash, right? But we recognize the revenue because the service or product has been provided. Figure up your new balances. Boom. All right, transaction F. The company purchased additional equipment for $5,000 cash. Equipment goes up by $5,000. Cash goes down by $5,000. And everything is still in balance, isn't it? Assets equals liabilities plus owner's equity. Situation C. Company paid an assistant $3,500 cashes. No, just $3,500 cash as wages for the month. Okay. Kind of that situation there again. I kind of wish they would say that expenses are increasing by $3,500, but eventually that those are subtracted in arriving at equity. Okay. Of course, cash goes down.
Top line though, is if you goes across and it tells you what to do anyway.
Yeah, but I still like the way I do it better. Okay. I just think when you look at this, like for example, take out that plus sign I just wrote in front of the 3,500. There's an implied plus sign there, isn't there? But I just think upon a quick look, you might think incorrectly that expenses are going down. So I like to put the plus sign there. But I'm anal retentive, right? I'm an accountant, so that's my nature. As long as you understand it. On cash, sometimes students have a hard time getting their signs right. Cash is just easy. Think about it. Is cash leaving me or is cash coming in to me? If cash is leaving me, it's minus. If I'm getting cash, it's plus. When you pay salaries, you're writing a check and some of your money is going away, isn't it? So it's minus. Okay, refigure your new balances. Everything's good. What about situation H?
You don't do anything, right? Because it's already been.
Okay, it's a good question here. Let's read what it is. The company collected $6,500 cash as a partial payment for the amount owed by the client in transaction E. You are absolutely correct that we do not recognize revenue here, right? Because we've already recognized the revenue. However, we have to decrease the receivable and we have to show the increase in cash. Okay? So we do have to analyze it. There's just nothing happening over there in the revenue column. Okay? But our receivable, they don't owe us $9,500 anymore, do they? They paid $6,500 of that, so now they owe us only $3,000, and our cash went up by $6,500. Okay? Questions on that? Don't hesitate to ask. Cash went up by $6,500. Our accounts receivable went down by $6,500. Okay? They owe us $3,000 more. Everything still in balance? Yep. Okay. I, the company paid $25,000 cash to settle the liability created in transaction C. Well, our cash goes down by $25,000 and our accounts payable goes down by $25,000, doesn't it? Okay? Everything's still in balance. They recompute the balances. Everything's good. And then lastly, J. Owner withdrew $1,500 cash from the company for personal use. I'm going to do this again. Your withdrawals actually goes up but those are subtracted in arriving at total equity. And your cash, now this was one that students get tricked up on because they think, okay, the owner withdraws cash, they need some cash. So shouldn't that be plus 1,500? No, you're looking at it from the company's perspective, not from the owner's personal life. You took $1,500 out of the company, correct? So it's minus 1,500, okay? Cool? And then they recompute the balances. Once again, you can see that that the accounting equation remains valid. In other words, assets equals liabilities plus owner's equity. Cool? All right, questions on that? All right, good job. Looks like everybody's doing their work. I like that. All right, we have one more question, one more homework, did we not? And it's kind of a switching gears a little bit. That exercise 1.8. Was that tricky at all at eBay? Sometimes that's tricky. I'm going to show you how to do it, which I think is an easy way to do it. Okay, exercise 1.8. Answer the following questions. Hint, use the accounting equation. Okay, office supplies has assets. Okay, and keep in mind here, I guess office supplies is the name of the company, is it not? Okay. The assets equal 137 and liabilities are 110. What's the total equity? What is the total equity? That one's a pretty easy one.
27,000.
27 grand. 27,000. Okay? Now, I think this one's a little bit more confusing. B. At the beginning of the year, Addison Company's assets are 259 and its equity is 194,250. During the year, assets increase 80,000 and liabilities increase 52,643. What's the equity at the end of the year? Okay? Did anybody look at that and go, what? Well, let me show you kind of how I do these. Okay? All right. We know that assets equals liabilities plus owner's equity, correct? And we know that this has to be true for the beginning of the year and at the end of the year. Okay? Now the beginning of the year plus whatever change happens, change donated by Delta for you science class people. This is the change. This always has to equal. Okay, so let's write in what we know. At the beginning of the year, Addison's assets are 259. And its equity is 194,250. Is that correct? Let me read that. 194,250. Okay. Well, right away I can figure out liabilities there, can't I? 64,750. Okay. What do they go on and tell us? During the year, assets increase $80,000. And liabilities increased 52,643. Well, they sure didn't give me easy math to do. So assets at the end are 339,000. And liabilities at the end of the year, is that 117,393? Yeah. And so equity has to equal, let's see, if I do that in my head, I get 221,607. I'm pretty smart, okay? Now, if I wanted to, I could figure out the change here, and that would equal across as well. But they asked us for the equity at the end of the year, and that's our answer, correct? Do you see how I did that, though? I have to write that kind of down in that format, okay? Let's do C real quick. We'll do it the same way, okay? Okay. Beginning, end, the change. Okay. At the beginning of the year, Quasar's liabilities are equal to 57,000. Okay. So 57K. During the year, assets increased by 60,000, and at year end, assets equal 190. So they increased by 60, and at year end, they are 190, right? So what plus 60 equals 190? 130. Can now we solve this way? It's like a Sudoku puzzle, isn't it? Right? Okay. What's the owner's equity equal? What is that? Oh, they did it different in the. I think it's 73, isn't it? Okay. Okay. Let's see what else they tell us. Liabilities decreased 16,000 during the year. Okay. So liabilities go down by 16,000. So what's 57 minus 16? 41,000, correct? So what does ending equity have to be? 149? Is 149 plus 41 equals 190? Yes. So that's our beginning equity. That's our ending equity, right? It's just like a Sudoku puzzle. It's kind of fun, isn't it? A lot of students on dates and stuff will do problems like this just for fun. I'm just kidding. They don't do it. But it'd be nice if they did. Okay? All right. Any questions? I think that's the homework, is it not? Okay? All right. I usually like to have one of those on the test because I know you enjoy them so much. All right? Questions on anything? Questions on anything? Let me check my notes, make sure we're going over everything good. Okay. What I'd like to do right now then is to spend the rest of the time on a very important subject, and that is the introduction to the financial statements. Now, I believe when we spoke in the first session, I talked about how the main objective of accounting, financial accounting, is to provide financial statements to users in order to help them make better decisions, correct? So these financial statements that I introduced you today are the financial statements that we're going to prepare in this class, okay? These financial statements will help users make better decisions. Now, are we primarily concerned with internal users or external users in financial accounting? External. That's not to mean that the internals won't ever use these or they don't care. But that's right. The external is primarily who we prepare these for. Okay? So I want to go back to your PowerPoints, if you have that. Once again, counting equation must remain in balance. But now let's hop down to where I start my financial statements. Oops, I got to go way down. Sorry about that. This is a good review, right? Look at all these. Okay. Let's prepare the 4 financial statements reflecting the transactions we have recorded. Okay. Up on the screen or in your handout, these are the 4 financial statements that financial accounting is primarily interested in. Okay? Now, I want to say something very important here that I don't think your book emphasizes as much as I would like. Okay? The first statement is the income statement. The second statement is the statement of owner's equity. The third statement is the balance sheet. And the fourth statement is the statement of cash flows. Okay? This is not only the 4 statements that we prepare, but this is the order that you prepare them in. Okay? So what I am saying is that you have to prepare the income statement before you prepare your statement of owner's equity. And you have to prepare your statement of owner's equity before you prepare your balance sheet. Does that make sense? That's very important. Because when we work on financial statements, and I say prepare your financial statements, if you start, Brian, on the balance sheet, you're going to have trouble because you need to do your income statement first, then your statement equity, then your balance sheet, so forth. So this is the order that you have to prepare those things, okay? That'll help you out. Now let's talk first of all about the income statement. Now the income statement is shown above, and it is sometimes called the P&L, which stands for the profit and loss statement. But it is the difference, net income is the difference between revenues and expenses, and hopefully revenues are greater than expenses. But it shows the company's revenues and expenses and the resulting net income or loss for a period of time due to the activities that you had that time period, okay? This is obviously a very simple example. They had revenues at $3,000, expenses at $800, and net income of $2,200. Now, I want to point out some stuff that's real important here. Look at the top of that statement in the purple here, okay? I'll circle it with the pointer, okay? Right here, all this stuff. I want you to have that. When I say prepare your financial statements, I'll be saying prepare your financial statements in good form or in proper form. What does that mean? That means I want you to, number one, what company are we analyzing here, or what company is this financial statement? Let's go back to the PowerPoints again. We want to show that this is Scott Company. The second line, what is the financial statement? And the third is we want to date it properly, okay? Don't just show me what's in the white box. I want to see what's up in the purple box as well. There's a number of reasons, but one of them is just ease of use or ease of understandability for the user, okay? Now going off of that for a second, it's kind of like, do you ever find a page of numbers or something at work and you're like, what are these numbers, right? Every now and then I'll write a phone number down on a Post-it note and I won't write whose phone number it is. Have you ever done that? Drives you crazy. Well, imagine looking at this income statement and there's just numbers there. There's not Scott Company income statement or date. It's not a whole lot of use, is it? Okay? So when I say to prepare these in proper or good form, I want you to do it just like it shows here. Now I want to say something real important here. We are talking about revenues and expenses, right? Look how that is stated. For the month ended December 31 of 07. Let's talk about why that is so, okay? Let's come off the PowerPoints for a second, okay? All right, let's say, Gil, let's say that I asked if you had a job, and you said, yes, you do. And I said, what do you earn in your job? And you told me, I earn $1,500, okay? Is that a good wage? Is that bad wage? What do you think? Good job or bad job? We don't know. Because if he tells me if he earns $1,500 per year, that's not a whole lot, right? But if he tells me he earns $1,500 per month, it's better. What if he tells me he earns $1,500 per week? Pretty good job. What if he says he makes $1,500 a day? I want that job, okay? So when we talk about revenues or what you earn, you can't just say the ending date today. You have to say for what period of time are we talking about? Does this make sense? Look back at the PowerPoint again. It says for the month ended December 31 of 07. Now this could be dated for the year ended, for the week ended, for the quarter ended, but we need to know the beginning and the end of when we're keeping track of this revenue. Does this make sense? Do you see how on this financial statement, if we just said Scott Company income statement, December 31 of 07, that does not tell us what time period we're referring to. Is that correct? You have to say for the month ended December 31 of 07 in regards to revenues. Now, if you just on your test or on your quizzes, if you just put December 31 of 07 as opposed to for the month ended, I'm going to lovingly take off a point because it doesn't make any sense. You with me? It's the same way with expenses. Peter, if I asked you, do you have a cell phone? Yeah. If I said, what is your cell phone expense? And you said $100. Is that good or bad? I don't know. Is that $100 for the week, $100 for the year, $100 for the month? What is it? You see what I'm saying? So once again, going back to the income statement, when we talk about revenues and expenses, we cannot just put December 31 of 07. We have to say for the month ended or for the year ended or whatever. Very important concept. Does that make sense? Very important concept. That is the income statement. What is our resulting net income? It's $2,200, correct? Okay, $2,200. Now, what's the next financial statement we're going to prepare? The statement of equity. And there is the statement of equity. It might be too small for you to see. You might have to look at your PowerPoint handouts. A statement of owner's equity just shows the owner's equity for a period of time. It shows them their beginning equity and then what their ending equity is. This statement is also prepared in good form. Says the name of the company, the name of the statement, and it says for the month ended December 31 of 07, correct? Okay. Shows the beginning balance of owner's equity or capital. And this is going to harken back to the quiz that we discussed in regards to what increases owner's capital and what decreases owner's capital. Okay? Now, if you remember from that quiz, investments by owners increased equity, increased capital, correct? What was the next thing that what was one of the things that decreased owner's equity or capital? Withdrawals. Looking at that financial statement again, we can see certainly that investments by owners increased capital and withdrawals by owners decreased capital. Now here's where you might say, hold on a second, Dave. You told us that revenues increase capital and expenses decrease capital. And yet on this slide for statement of equity, we see that net income increases capital. Okay? All right, it is true, keeping on the slide here, it is true that all revenues increase capital. It is true that all expenses decrease capital. However, what we do in format is we only show the net effect on the statement of equity. Does this make sense? I guess if you wanted to, you could say plus revenues of $3,000, less expenses of $800, but nobody does it that way. You just show the net effect of the $2,200. Now, if this company would have had a net loss, we would have showed that net loss down in there by the withdrawals. Does this make sense? But yes, all revenues increase capital. Yes, all expenses decrease capital, but we just show the net effect. Are you with me? So those are the first two statements. Erica, did you have a question?
Yeah, it kind of goes back a little, but when you were talking about how you have to have the name of the company and everything, can you have specific dates, or does it have to be for the month ended?
No. You mean like give me an example. Could it be?
Could it be like January 22nd to
Oh,
February
okay. I see what you're
22nd
saying.
instead of
Yeah, go back to the
month
slide.
ended?
What you're saying is, could this say December 1 of 07 to December 31 of 07? Yeah,
have to be
I probably wouldn't count off for that. It's probably not classical formatting, but it would show that there's a given period of time. It would say the beginning and the end of that time period. Okay? And note here that as we look at the statement of equity and the income statement, the headings for them will be exactly the same. Okay? You with me? Yeah. Those are the first two statements. What's the third statement? Well, first of all, before we go to the third statement, what's the ending balance of capital? 21,700. By the way, do you see how it would have been hard to prepare this statement of equity without doing the income statement first? Because we had to take that income of 2,200 over to the statement of equity, right? So you have to prepare these in a certain order. Okay, the capital, which I kind of mangled up here. The ending balance of capital is 21.7. And sure enough, we're going to take that over to the third financial statement, which is the balance sheet. Now, we call this the balance sheet because it shows us that the accounting equation is in balance, namely that assets equals liabilities plus equity. Okay? Now, there is that owner's capital of 21.7 right there, right? So you can see why we have to prepare this one after we do the statement of equity, correct? Now, the balance sheet shows a company's financial position at a point in time. Now, this one is prepared in good form. It says the name of the company, the name of the statement, and it is dated properly. But this date looks a little different than the previous statements, does it not? This does not say for the month ended or for the year ended. This just says, boom, December 31 of 07, and that is correct the way they have it here. The way you do a balance sheet is you say the date, just like it states, or you could say as of. Well, why is that the case? Okay, well, coming off the statements for a second, okay? Zach, let's say you had a car loan, a liability, right? And I said, what is the amount that you owe on your car loan? And you would say, and you could call up and get a payoff amount, but they would say, as of today, you owe $11,200.62. Now, a week ago, was that the same amount? Probably not. It's probably not even going to be the same amount tomorrow because of interest. So if you're talking about a liability, you're not talking about a period of time. No, as of boom, right now, this is what you owe. It's like a snapshot. Does that make sense? So if you said for the month ended, I owe, no, that's implying that you owed the same amount every day. So when we talk about liabilities, we don't say for the month ended or for the year ended. We just say, boom, as of this date right here. It's the same way with your assets, okay? Same way with your assets. Erica, if I asked you how much cash you had in your checking account right now, you would say, boom, I've got $463, right? As of today. Now, a week ago, it was probably different, right? Tomorrow, it might be different. So again, we're talking about assets and liabilities. We have to talk about a point in time, not a span of time, but an exact point in time. It's more like a snapshot. Do you understand? That may seem picky, but I want you to date those financial statements correctly. Income statement, statement of equity is for the month ended or whatever. Balance sheet is, boom, just that date, as of a point in time. Are you with me? Okay. The other thing I want to point out is on this financial statement, I want you to make sure you do this total, and I want to make sure you do this total as well, but the other thing I want to make sure of is that they equal, first of all, right? But I also want you to label these. Total liabilities and equity. Total assets, okay? I don't like to leave numbers just hanging down there. I like to tell the readers, what is this number? Well, that 26.9 is total assets. That other 26.9 is total liabilities and equity. Are you with me? So don't just leave unlabeled numbers there. Tell the reader what it is, and they want to see that that balances. That will make them feel very good. The fourth financial statement is the cash flow statement. Now, this shows the cash inflows and outflows for a given period of time. All I want you to do is really just look at this statement and be aware that it exists, but we are not going to prepare this financial statement in this class. It's beyond the scope of this class. Anybody going to take Accounting 2? They already know they're going to take it. You're going to learn how to prepare the cash flow statement in Accounting 2. But for now, just know that it is the fourth of the required financial statements for financial accounting. And note kind of what it looks like, but you don't have to prepare it, okay? All right, we are just about out of time. I knew we would use our whole time today. So what I want to do is assign you your homework, okay? So let me put that up there now. I want you to do quick study 1:11, and 1:5. Okay? And I want you to do exercises 1:13, 1:14, and 1:15. Now this is preparing the income statement, the statement of equity, and then the balance sheet. So you need to do them in that order, okay? It's very important, though, that you do this homework. You're not going to learn accounting by just watching me do it or watching me go over the answers of the homework, okay? You folks at home, same thing. Have that discipline. Do your homework. So that's the end of class. We will see you next time. Good job, guys.